We're in the end stages for a lot of things. Those are the words of my guest today, Edward Dowd, as he believes the broad market is in a massive bubble, largely being inflated by AI stocks being priced on a hope and a dream. He also sees major trouble coming for the real estate market, debt markets, and the Chinese economy, which he also thinks is headed for disaster. The silver lining is precious metals. Ed believes gold will eventually climb to $10,000 an ounce. We break all of this down and more in our conversation ahead. Edward Dowd, great to have you back on Commodity Culture. I want to start things off today with discussing precious metals markets, because since hitting all-time highs near the end of January this year, both gold and silver, of course, have corrected and are now in a sideways consolidation. Do you think the next move from here is to the upside or to the downside? Obviously, that's the $10 million question. And what are the factors you see currently driving precious metals markets?
Well, I was bullish precious metals last year in 2025. Had a near-term price target of 4,000, and it exceeded that. And over the last 6 months, I've been asked a lot about gold and silver, and my long-term viewpoint is that gold is going to 10,000 by 2030, and that's due to a host of factors we all know about: central banks buying, potential new monetary system coming, the date of which is very uncertain. Gold is going to be a part of that. How do we know that? That's because commercial banks made gold money again by making it tier one capital. We have retail investors in China and India, voracious appetites for gold and silver. So the fundamentals are there. But there was a tremendous move over the last 2 years into the top in January of this year. And I said then that I expected to consolidate, and that's what it's been doing. And that's healthy. Gold is not showing signs of a parabolic top, meaning it's already down 40%. So this is quite healthy. Silver is a little more volatile. It is an industrial metal. So I expect them to continue to consolidate. There might be some short-term scares if there is any kind of credit or liquidity crunch. I don't expect gold and silver to go down. Well, silver is tied to the economic cycle, and I'm bearish on the global economy. But I wouldn't worry about gold and silver if you're a long-term holder. If you're trading it, flip a coin. If it's going to go up or down, I just think it continues to go sideways, and that's actually the healthiest thing. If your long-term target, like I have, is 10,000, after a big move like this, and you consolidate, the longer you go sideways, the more confident you are you didn't put in a parabolic top.
I'd love to get your thoughts on gold and silver's price action in the midst of this war in Iran, because I've spoken to a lot of different analysts, and some have said that this is normal in a time of global conflict. There's a rush for dollar liquidity. And so in that case, you often see countries, governments, corporations, retail investors as well, for whatever reason, liquidating their physical gold holdings in exchange for US dollars. Is that how you see things, the way that they've played out so far? And if this war continues to drag on, do you think that trend could reverse somewhat? We could see that safe haven status for gold in particular kick in and perhaps cause a price move to the upside?
Yeah. So, there were when the conflict started, people were surprised by the price action in gold. And mind you, it's still consolidating. It didn't drop precipitously. It was due to liquidity raising. People sold what they could, not what they wanted to. And Turkey sold, I think, 120 tons of gold to raise liquidity. So just like some of these top analysts you've talked to, that happens. Right now, the market, the stock market and the oil markets are discounting a resolution to this war. That's what they're telling you. And we put out two scenarios when the war started on the price of oil and what inflation might do, at least short-term headline inflation. And one scenario was $125 oil and 5% inflation by May, and then we get a resolution, and then inflation starts rolling over, and we continue what we were seeing was an economic slowdown, and the oil price shock only adds more pain delayed. There will be problems going forward. If we do not get a resolution soon, there are executives from Exxon and other oil companies talking about we're approaching in 2 to 3 weeks the bottom of some reserves around the world, and that oil will spike up, and some are predicting $150 oil soon. If that were to occur because there's no resolution to this crisis, gold may go up. I don't know, but it'll definitely shock. The yields will spike again temporarily, and I think this equity rally, which has been 100% AI, will falter and correct. And I still think the equity markets still have a lot of risk. I wouldn't touch this market with your money. We're seeing unprecedented, uh, Five Sigma things going on, all sorts of signals that we see at tops. But again, it could go higher. I suspect the market is going to stay kind of elevated until the IPOs come, and then we'll see what happens. A lot of supply is coming, and a lot of the Mag 7 that used to do stock buybacks because of their CapEx spend won't be doing as many stock buybacks. So I think we're in the end stages of a lot of things. I actually would prefer to see the Iran war. Look, I'm bearish on the economy, but I don't want to see this dragged out, just so that I can be right. So enough damage has already been done, and I want to see this resolved, because if it isn't resolved, the oil markets and the stock markets are discounting it's already resolved. So it better be resolved.
Yeah, some great thoughts. There's two things I want to follow up on there, both the broad market and the energy market. Let's start with energy, because in previous conversations before the war started, you were fairly bearish due to your bearish overall outlook on the global economy, which made a lot of sense. Now that the Strait of Hormuz is being closed, we've seen WTI in triple digits. And, once again, we keep seeing oil rally and then fall based on tweets, essentially reports coming out of the Trump administration that, okay, peace talks are advancing, everything's going good. Iran says, no, they're not. Oil goes back up. As soon as peace is apparently back on the table, we see it drop again. It's been a bit of a seesaw action for both oil itself as well as the equities. Are you now getting more bullish on a longer term view? Once again, there's one of two scenarios: this conflict continues, the Strait of Hormuz continues to be closed, or we do eventually get a resolution, which of course we're all hoping for. In both of those scenarios, how would you see oil performing?
Oil, if we don't get a resolution, oil could go to 150, maybe 200. And so that might be a trade for the energy complex, a trade. But long term, given where the consumer is, given where we see the global economy and China rolling over, longer term, we think energy complex is going to get hit and then recover massively once the monetary authorities start printing in the teeth of the crisis that we believe is coming. So energy, if the conflict isn't resolved, it's a trade, but it's a quick trade, because then the furious demand destruction will come, and oil. The sure sign to killing an oil rally is high prices themselves, because it causes demand destruction. We've seen that time and time again, and we saw it in '08. We saw it in the '73 oil crisis, and there will be demand destruction if there is no resolution. But there could be a trade in energy. I honestly think that's too tricky and tough. That's for professional investors. That's not for the average person who's trying to figure out what to do with their 401k.
So do you think if peace is declared tomorrow, we'd see WTI drop back down to the $50, $60 level?
Not immediately, but yeah, it'll be on its way.
The sponsor of today's episode is ARC Silver Gold Osmium. Owner Ian Everard is praised even by his competitors as one of the most honest and level-headed bullion dealers in the United States. They have some great prices. You can see some of them displayed right now on screen. Take advantage of these specials today by reaching out to Ian at 307-264-9441 or by email at ian@arcsgo.com. Make sure to tell him, of course, that Commodity Culture sent you. And now, back to the interview. Well, let's talk about the broad market now because you noted recently on X and you just spoke about it a moment ago. 45% of the S&P 500 market cap is AI or AI adjacent. We've got a storm of controversy emerging now over data center buildouts in the US, along with some reports that perhaps AI isn't going to completely take over white collar jobs and revolutionize the economy the way that many have been promoting it. How big is the risk here when it comes to the AI segment of the broad market? And what could the aftermath be, assuming this AI bubble pops? You said you feel like we're in the end stages at this point.
Yeah, look, I thought the bubble was popping, quite frankly, prior to the war. We were starting to see the complex wobble private credit was getting hit. Um, the war actually, I think, kind of gave one last leg of life to it because the only thing that's working right now are AI stocks and earnings, but the earnings are all circular. Free cash flow is going the wrong way. There's a lot of controversy, as you know, about the AI complex, and Michael Burry's come out and said that Nvidia and all these other people are committing off balance sheet fraud. It's legal, but the risk is being put elsewhere, and it all is a house of cards. Um, right now, what I'm seeing, or I've been doing this a long time. What I saw with the semiconductor after the low put in early April, the semiconductors are up 80% in like 9 weeks. Semiconductor index. Um, I talked to professional investors. There was a reason for it because there was a demand surge, and then there was people worried and pre-ordering for helium shortages and whatnot. And then of course we have the speculation going on in the Korean market. 50% of their market cap is two stocks, Hynix and Samsung. These are ending moves. When you see this kind of speed and people chasing and no more. We're just getting signals of all sorts of things we haven't seen that are most likely ending moves. But again, I'm not calling a top. I'm not telling people to short. I've always been on this of the mindset you have dry powder in your portfolio. You raise some money, and that's personal, up to you whether you want 20% cash, 25, 50. And then, when the correction comes, and it will come, I was less bearish last year. I thought we might get a slow decline of 40 to 50% over 2 years. This kind of action is crashy to me, meaning we'll put in the top, we'll have a drawdown, then we're going to counter trend rally, then we could get a crash. I'm not calling for a crash, but the risk for a crash is a lot higher now because it's so concentrated. And semiconductors are notoriously cyclical. It's an industry that has booms and busts. That hasn't changed, and it's now 18% of the S&P 500 index, the semiconductor industry. It's 30% of the Nasdaq, and I've done this over and over again. We're starting to hear whispers of double ordering because purchase managers need to get their allocations so they can make their products. So they about 6-7 months ago they started asking for 500. Let's say you ask for 500,000 units and you say, oh, we can only give you 250. Well, then the next time you order, you double your order and say, so the backlogs look way better. There's a lot of enthusiasm, but when the supply and demand meet, there's inventory buildups everywhere, and that's what's going to happen. It always happens. So I'm just very cautious on this market, and given the global risks and the oil price shock that's working its way through the economy, margins are going to get squeezed in the non-AI sector of the economy, which is the real economy. I mean, the stock market is not the real economy. 45% of your market cap is AI, and there's no profits yet. What are you investing? You're investing in future hopium. You're not investing in actual earnings and growth. Now, people are speculating it's going to turn in earnings and growth. And as you mentioned earlier, there's all sorts of questions of data center delays because of opposition, not enough power on the grid anyways. And now Bloomberg came out with a story today. Bain, a consulting company, said there is no ROI. It's a bust. So, the markets can continue to be irrational and go up on this, but the narrative is changing fast, in my humble opinion.
In the aftermath of this bubble popping, I mean, in terms of picking up the pieces, would you be cautious there as well? You know, many could imagine that they'd be catching a falling knife in such a scenario. And I've spoken to some people. Dave Collum comes to mind, who says we could be in for a decades long grind sideways after a precipitous drop in the broad market, perhaps similar to what the Nikkei did for several decades. Do you think that's a possibility? At what point would you start looking for bargains in that type of scenario?
Well, that's difficult. What we don't know is I do think there'll be a 30 to 50% decline, and I say third. I'm hoping for 50. I say 30 because the policymakers may not allow the stock markets to fall that far and may come in with bazookas. I don't know because I don't know what the bazookas look like yet. So you have to kind of call it in real time. So right now, I'm cautious. I would not put any new, fresh money to work in the stock market at these all-time historic valuations. Warren Buffett himself is 40% cash. You know, his stock has underperformed the S&P 500 the last year and a half. That typically happens before major market corrections because he starts accumulating cash into the top, and he's got so much money. He doesn't call the top, but he's been cautious like we have been for 2 years. We've been early and wrong on the stock market, but not wrong on the rest of the real economy. The real economy is in tatters. The housing market is rolling over, and we've been right on our call on gold. But in the stock market, we were early, but I wouldn't touch it here with your money, and very cautious. You know, I've done this a long time, and here's another indication of how crazy it is. An old video of Trump talking about IBM in December recirculated on Thursday, and IBM's up 30% over the last 2 days as a result of an old video. Yeah.
That is completely insane. I want to talk about the real economy now because David Rosenberg was recently on CNBC where he stated that real incomes are decaying, but spending is holding up only because the savings rate dropped from 5.5% to 2.6% in a year. Talk about this disconnect between Wall Street and Main Street and what the ultimate result of this K-shaped economy will be.
Well, so it's gotten so bad now that the top 10% of the consumers are responsible for like 49% of all the consumer spending. So there's a small cadre that are continuing to, you know, go about their lives and very comfortable in their lifestyles, while the rest of the population is struggling mightily. And we know that because we see credit card delinquencies rising, car loan delinquencies rising, and now we're starting to see mortgage delinquencies rising. So at some point, that will affect everything, especially credit, and they're drawing down their savings and they're putting what they can on their credit card, and this can't go on forever. And with the oil price shock, this is what happened in '08. Same thing was going on in '08, and there was a small mini oil price shock. People don't remember it. It's all housing, and people remember the Big Short. But I remember oil going to 140 from like $70 over a 5 month period. It was a mini oil price shock, and that wiped out the consumer in the second half of 2008. And inflation did rise going into that headline inflation. Then it rolled over when the recession hit.
How are you viewing the government debt market at the moment? Because we've seen yields rising, many government bonds at levels not seen since the great financial crisis. The US 20 and 30 years sitting at around 5% yield right now, a level some analysts are pointing out could be signaling trouble up ahead. What are your thoughts on the sovereign debt market? And could an unwinding there cause the broad market to crack as well?
Well, the sovereign debt market is already in trouble. We've seen Japan yields rise, yields around, and even our 10-year and 30-year. Interestingly enough, the 10-year and the 30-year in the U.S. have started to recover, and yields are heading back down. I think this is for institutional investors. If you're a retail investor, having dry powder, which is cash, short end of the curve, no interest rate risk, that's where you should be. But if you're an institutional investor, I think there's an opportunity for at least a 12-month trade to get into the 10, the 20, and the 30-year, go out on duration in just the U.S. Treasury market in a credit crisis and a slowing global economy. that market will discount the growth scare, and there'll be a rally. Then the Fed will come in and do what they do, and then you're going to have to, kind of tactically get back out of that and into equities, depending upon where they are. If they're down 40, 50%, then you rotate back in. But I think there's an opportunity, and I think the scare in the yield market, at least in the U.S., is we're not going to 10% yields. I may be wrong, but I think and you got to look at China too. China is in deep, deep trouble. They're the factory of the world, and they are now entering the acute phase of their crisis. And we know that because their total construction value started to decline in the fourth quarter of 25, and now it's down 8% year over year. They're in deep doo-doo, and that's going to have contagion effects. And the oil price shock will kill demand. So we're in everything seems great according to the stock market, but underneath the surface, it's not good at all.
Let's switch over to China then, because I speak to different people who have different opinions. Obviously, you've been pretty consistently bearish on the economy. Louis Vincent Gave, who I speak to sometimes, is very positive. He has an office in Hong Kong, and Simon Hunt as well, the China specialist, thinks that their economy's got its issues, but perhaps not in as dire straits as you're painting in terms of the picture you have. You appeared on Steve Bannon's War Room recently, where you said their economy continues to face major challenges. Now, one interesting question I have is about their sovereign debt market, because their yields have been consistently falling over the years, signaling potential strength. Why do you think that is? And just lay out your scenario for us on why you think China is headed for trouble in a bit more detail.
Well, their bonds yields are going lower because they're in a deflationary demographic decline. So that's what happens in the deflation. Sovereign yields go a lot lower. Most of their debt is in the private sector, and they have a tremendous amount of private sector debt that was used to build out the factory of the world. Here are the numbers. Their demographics plateaued in 2015, went sideways, and then in 2020 it started a precipitous fall, and it goes into a low in 2032. They're losing 150 million people of prime age workers, meaning their spending profile goes from consumer to saving and retirement and hunkering down. So they're losing 150 million people over the next 7 years. It's a 1% decline. The real estate market the residential real estate market is a disaster. Permitting is down 70% since 2020. 2020. That's permits. That starts. Their land sales, which they discontinued the series in 2023, plummeted. So their residential real estate build out is over effectively. Their total overall residential real estate construction didn't start dropping until like a year or two later. It's down only down 20%. That's in residential, but that's because they had some long life projects. But the tell for us that this is getting acute is overall construction is going lower. And so what's going on is basically they are reaching the acute phase of their crisis, and their GDP is struggling. I think the fourth quarter GDP was one of the weakest on records in a long, long time. So it's happening, and they did some stimulus in Q1. It didn't really work all that well. Total construction continues to come down. Net fixed investment went negative for the first time in the fourth quarter. Recovered a little bit year-over-year growth in Q1, but it's nowhere. The trend is down. So this is a problem. And so what they've done with so they have deflation, and there's the internal demand is falling off a cliff. So when you have internal demand falling off a cliff, much like Japan did when their demographic decline hit, you need to export your way out of it. So that's what they've been doing. So they really ramped up exports since 2020. EVs, automobiles, their tech sector. So they really have ramped up exports. But now we have the tariff wars, and that's thrown a wrench into it, because they were trying to dump their deflation on the rest of the globe, and that would be a problem for everybody else's homegrown industries. They'd be bankrupted by the dumping of the cheap goods. So that's why Trump has got this tariff situation. It's the right move. How he executes it, you can criticize, but strategically, it's the right move, and it needs to be done, because if that doesn't happen, They're going to export all their deflation. So China is internally has big issues. That's going to affect their trade partners like Japan and Korea. Those South Korea and Japan are the biggest trading partners in not trade deficits, overall imports exports. So and Japan is Japan has a sovereign debt crisis potentially blooming right now. So there's so much risk in Asia that people are just ignoring. They're focusing on the AI. They're focusing on the Iran war, and they don't understand that the factory of the world is in trouble.
I want to run another narrative by you that's been pretty persistently coming up, which is that China is kind of leading the charge in terms of removing the US dollar as the global world currency. And the evidence that people point to is some of the trades they've been doing for oil with Iran and renminbi. Some people speculate that a big part of the war in Iran is to stop that from happening. So the dollar can remain the global reserve currency status. The other is the fact that China is the number one gold producer in the world, and it's widely believed that they are understating the actual gold reserves that they have as a country as well. What are your thoughts there? And even aside from that, do you think China having so much gold gives them some sort of cushion when it comes to negative economic effects moving forward?
They have a lot of debt, so there's going to be a lot of debt destruction. And honestly, I'm not going to get into it because this is for institutional investors, and we sell a report on it. We think the yuan is wildly overvalued and is going to need to depreciate quite a bit. And they're trying not to let that happen, but increasingly, I think that's going to happen. So this de-dollarization. Look, has the status of the reserve currency been challenged? Yes. Will it die suddenly? No, it died slowly. And the Biden administration, when they threatened to take Russia's assets and then use the SWIFT system to put sanctions on them, we didn't even do that during World War II. So that is one of the things that really concern me about the de-dollarization efforts. But it takes time because of the global interlocking and the dollar liquidity that everybody needs currently, especially with a lot of these countries. There's about 20 trillion in foreign debt denominated in U.S. dollars, both from foreign corporations and governments. So if there is a de-dollarization effort, that's a problem for them because if they went off the dollar, they would have a deflationary crash overnight. So it's a process, and I'm not worried about the dollar de-dollarization, dollar going to zero talk anytime soon.
I want to circle back to AI for a moment and talk about Peter Thiel. He is now relocated to Argentina. I'm going to read a quote from the New Yorker. Mr. Thiel has met with the country's president, Javier Milei, and his ministers, purchased a mansion in one of Buenos Aires' most exclusive neighborhoods, and hosted a dinner with local economists where he discussed the Antichrist, one of his favorite conversation topics, according to Argentine officials and people familiar with Mr. Thiel's activities. Now, Thiel already poured a bunch of money into Trump's campaign, along with mentoring and essentially helping put J.D. Vance in place as the vice president. The red carpet now rolled out to him by the political elite in Argentina. Shouldn't this be worrying to people, the fact that a tech company CEO heavily focused on AI loves discussing the Antichrist and has this much political power? And if you were to speculate, what do you think his end game is?
Again, it's pure speculation. I don't know why he's done this. I saw one person speculate, which resonates with me. So I forget the person's name. So forgive me if you see this video and you think I stole it from you. I just don't remember your name. But they posited maybe he's worried about the popularity of Trump. He doesn't think Vance can pull it off. And because he was a well-known supporter of the Trump administration and Vance, he's worried about he's looking forward to 2028 and backlash that might come at him from the Democrats. So I don't know. That seemed to make the most sense to me.
Given everything that we've discussed today, are there any areas of the market that you're seeing opportunity in at present, or are you in a much more of a defensive posture? As you mentioned, dry powder, maybe perhaps short-term treasury bills, something like that? Or are there areas that you see right now that are being mispriced and that have potential upside opportunity?
No, I don't see anything terribly interesting that I'd want to own. When this risk is figured out and people figure out that we're in a growth scare, um, it's going to happen fast, and a lot of things will get mispriced. I'll have more to talk about maybe 6 to 12 months from now. Right now, I don't think there's a lot of bargains out there. I like being defensive. And look, I'm not telling people to go to 100% cash. If you're in your 80s and you've got 90% stocks, you might want to raise some cash. If you're in your 30s and you don't have a lot and you have just a 401k, just a little bit of cash. The older you are and the more you got to worry about.
Some great thoughts. Always love talking with you. Tell us about finance technologies and anywhere else people can follow your work.
Yeah, so we have Chinese economic reports, real estate reports, U.S. economy report, all at financetechnologies.com, available for purchase. PH is the beginning rather than F, so PH, financetechnologies.com. Also, I'm available, personal website at Dowd.com. I've been getting some success. I don't really advertise this, but a lot of people want to talk to me, and I do offer consulting services if you're interested on my website. You can also sign up to my website. Also, I'm also on Twitter, X, so to speak, at Dowd Edward, DOWD Edward.
I'm going to put links to all of that in the description below so people can check it out. Edward, thank you so much once again for coming on the show.
Thanks, Jesse. Great interview.
Thank you for joining us today. This episode is brought to you by Arc Silver Gold Osmium. They have some great prices on gold and silver bullion products. They are on your screen right now. These are subject to change and well supplies last. So reach out to owner Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. And Commodity Culture is hosting our first ever live boot camp on June 27th, Saturday, 1 p.m. Eastern Time. I'm going to open up my portfolio A to Z, show you what I own, why I own it, what I've been buying, what I've been selling, and my view on why commodities are the place to be for the years ahead. Join.jesseday.ca. The link will be in the description below, and I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.